In this video, we'll learn how to complete the pro-forma modeling part of the DCF model. The pro-forma model needs to include all the information required to compute unlevered free cash flow. In the modeling tab, we always have the model values or the model assumptions shown on the top of the page. For now, let's assume that the model values are given. Later on in the course, we'll learn how to make reasonable assumptions for each of the model values. Before we do anything, it's important that we set up the circular reference in Excel. So you will click on File, go to Excel Options, click on Formula, and make sure you check this box. Enable iterative calculation here. Because if you don't check this box, your pro-forma modeling is not going to work. And click OK. Next, we'll set up the pro-forma model using the financials from the most recent 10K. Let's take a look at what's included in the pro-forma model. It begins with income statement. Since we need to add the depreciation back to compute unlevered free cash flow, so we need to adjust the income statement by including depreciation in the income statement. Next, we need to also include interest expenses because we need to add the after-tax net interest on debt to compute unlevered free cash flow as well. So let's take a look at what's included in the income statement. So it goes from sales and then to COGS. The COGS is a lump sum that includes all the operating expenses. So if you include sales and cost of goods sold, COGS, then you have EBITDA or the gross profit. By taking out I and D from EBITDA, you have EBT. So you get rid of the I and then DA component from the EBITDA, so you have EBT. And then if you further take out the T component from EBT, you'll get profit after tax or the net income. Okay, in order to make the balance sheet balanced, we have to add retained earnings back to the income statement as well. Retained earning is essentially the amount of net income after paying out dividends. How much of net income is retained in order to fund the future operations of the company. Okay, moving on to the balance sheet. Balance sheet has several key components. On the left-hand side, you have the asset, total assets for the balance sheet. On the right-hand side, you have liabilities and shareholders' equity. So on the left-hand side, the asset always starts from cash and marketable securities, and moving on to short-term asset and then long-term asset. And if you sum up all three major asset classes, you get the total asset. On the right-hand side, you have the short-term debt and the long-term debt, and summing them up, that give you total liability. And then in the shareholder equity section, you have the amount of stock, and then stock plus accumulative retained earning, that gives you the shareholder equity. So if you sum them all up, you have the total liability and equity, which is the right-hand side of the balance sheet. And be aware that in order to have the balance sheet balance, the left-hand side, the total assets, need to be equal to the right-hand side for the balance sheet to balance. So now that you have set up financials for year 0, you can start to make forecasts for year 1. Okay. In order to forecast for each of the line items in the pro-forma modeling part, you have to identify which type of variable that is. So starting from sales, sales is the driver of pro-forma model, right? So the sales is basically the sales of the previous year times the sales growth rate. Okay, so it will be sales of previous year compounded by 1 times 1 plus the assumed sales growth rate on a year-to-year basis. And that gives you what is the sale for year 1. And COGS is the relational variable. So that means it's the change in COGS is tied to change in sales. So COGS is calculated using this year's sales times what is the model values for COGS as a percentage of sale, which is 50%. Okay, so use sales times 50%, that gives you what is the estimated COGS for this year. And because COGS is cash outflow, so you add a negative sign in front of it to mark it's a cash outflow. Okay, income payments on debt is an external variable because it depends on what is the external interest rate. And use interest rate on debt times the amount of debt we have, you have interest payment on debt. In order to make the forecast value smoother, I take a averaged out the debt from year 0 and year 1 in order to have this forecast value smoother as compared to the previous year's interest payments on debt. Similarly, the interest earned on cash and marketable securities, that's also external. So you have to use the interest rate on cash and marketable securities times what is the total amount of cash and marketable security from this year. That gives you what is the interest earned on cash and marketable security. And depreciation is also external, depending on depreciation expenses and the amount of depreciation rate and the amount of book value for fixed asset. Okay, and if you sum up all the previous variables, you compute what is the profit before tax or EBT. And if you take out tax is also external variable using the prevailing tax rate on corporate tax rate times the profit before tax, that gives you what is the amount of tax paid out this year. So you use EBT minus T, you get what is the net income or PAT, profit after tax. Okay, the next is to compute dividends and return earning. Dividends is a policy variable. So it's based on the dividend payout ratio, which is 40%. That means 40% of net income is paid out in the form of dividend. And that means what's remaining is return earning. Now moving on to the balance sheet section. So balance sheet, the first variable is cash and marketable security, and this is a plug variable. Plug variable is designed to make the balance sheet balance. So on the left-hand side of the balance sheet, the key components is cash, short-term asset, and long-term asset. And then if you use the total value on the right-hand side of the balance sheet, which is the total liability and equity, minus the net fixed assets and minus current asset, you should get the estimate for cash and marketable securities. So that's what you see here. So you have the total number on the right-hand side of the balance sheet minus the current asset minus the net fixed asset. That's your estimate for the cash marketable securities. Okay. The reason why you're doing this computation is because cash is assumed to be the plug variable in this case. Now moving on to the current asset. Current asset is tied to sales. It's a relational variable. So you have the current asset estimated as sales times the model value for current asset as percentage of sales, which is 15% of sales. Okay, and moving on to fixed asset. Well, there's different components under fixed asset. Fixed asset cost is the current total book value for all the fixed asset. And then if you use the total book value minus depreciation here is different to the depreciation in the income statement because balance sheet is a snapshot of all the historical financials combined. So this depreciation is in reference to accumulated depreciation expense. So this depreciation is previous year's depreciation expense plus this year's depreciation expense. And then net fixed asset is assumed to be relational because it's tied to sales. So the forecast for net fixed asset in year 1 is sales of this year times what is the model value of fixed asset as a percentage of sales, which is 77%. Okay, so once you computed, you made a forecast for net fixed asset and you computed depreciation, and then you can solve what is the total book value of fixed asset retrospectively by using net fixed asset and use net fixed asset plus the amount of depreciation, or you can think of it, since it's already negative, minus a negative depreciation gives you the total book value of fixed asset or fixed asset cost. Okay, so on the left-hand side of the balance sheet, if you're summing up cash, current asset, and net fixed asset, that gives you total asset. On the right-hand side of the balance sheet, current liability is also relational variable, is tied to sales. So the forecast for current liability is sales times what is the model value for current asset as a percentage of sales, which is 8%. Okay, and moving on to debt and stock. Debt and stock are policy variables. So the value for debt and stock are not going to change unless you read from 10K that the management indicates that they are likely to offer a debt or equity offering in the following year. And especially when we have assumed that cash is the plug variable, and therefore all the cash fluctuations are going to the cash account. So we're just going to leave the debt and stock account constant. So in this case, the forecast value for debt and stock in year 1 is set equal to their numbers in year 0. And accumulated retained earning is a retained earning of this year plus retained earning from previous year. Okay, and if you sum up all the numbers, you compute what is total liability and equity. That's on the right-hand side of the balance sheet. And the left-hand side of the balance sheet should be equal to the right-hand side of the balance sheet. So at the end, you can perform a quick balance check to make sure that your balance sheet balances. And once you've done that, you're ready to just copy over this formula to make forecast for all the future years. But before you do that, make sure that you have logged the rows and columns for all the model values. So when you copy over the formula, the numbers don't change. And once you have checked that you have done that, then you can just go to the next tab. And what you're going to do is simply just copy over all the formula in year 1 to cover the rest of the forecast horizon, and just press Ctrl+R to copy over the formula. And now you have the completed Pro-Forma model. After the Pro-Forma modeling part is done, assuming that you have done everything correctly, the next step is to use the Pro-Forma modeling Pro-Forma model to compute levered free cash flow. We'll save this part to the next lecture.